You are sitting at your desk. It's late, the glow of the monitors burning your eyes, and you are staring at a retirement calculator. The screen spits out a number, $1.26 million. That is the price of your freedom. That is the cost to stop working 40 years from now. You look at your bank account, and it feels like a leaky bucket. No matter how much you pour in, it never seems to fill up. You are trading your best years, your energy, your youth, your sanity for a maybe 4 decades down the line. And somewhere in the back of your mind, you are wondering, is there a way to stop this frantic saving without ending up eating cat food in your 70s? Here's the thing about the standard American dream. We are told to save a steady percentage of our income, rain or shine, for 40 years. Just keep swimming, right? But the reality is staggering. While the financial gurus tell you the magic number for a comfortable retirement in 2025 is $1.26 million, let's look at what is actually happening. The median savings for Americans aged 35 to 44 is a mere $45,000. Oh, but wait, if you look at the average, it says people that age have over $141,000 saved. That is a statistical lie. That average is being dragged up by a handful of wealthy outliers who are masking a massive retirement crisis. There's a terrifying disconnect here. The median, the real person in the middle, is nearly $1 million behind schedule. And the irony? The irony is that the harder you work to catch up later in life, the less time your money has to actually work for you. You are running a race where the finish line keeps moving further away. We didn't get here by accident. This wasn't a mistake. This was a systemic shift. We moved from company-funded pensions, where the risk was on the employer, to individual-funded 401ks, where the entire weight of financial survival was dropped directly onto your shoulders. Research shows that over 54% of American households now have no dedicated retirement savings at all. Zero. And while you're trying to fill that leaky bucket, the economy is punching holes in the bottom. We're living through a period where inflation is relentless. The Consumer Price Index tracked a jump from 317 to 324 in just 1 year. That means every dollar you manage to squirrel away is worth less by the time you actually go to spend it. Purchasing power is eroding right before your eyes. The system is no longer designed to take care of you. It is designed to see if you can outrun the clock. But there is a way out. It's called coast fire, and it works because of the physics of compounding. Think of your retirement fund like a rocket ship. To get a rocket into space, it burns 90% of its fuel just to break the Earth's orbit. It takes massive energy, massive effort just to get off the ground. But once it is in space, it floats. It moves at thousands of miles an hour with almost zero effort. This is what happens when you front-load your investments. If you look at the S&P 500 returns from 2023 through 2025, we saw massive total returns, over 26% and 25% respectively. This isn't just luck. This is the engine of growth. By aggressively investing in your 20s and 30s, you reach a tipping point. This is the moment where the annual growth of your portfolio, the interest it earns just by sitting there, exceeds the amount of money you could contribute from your salary. When you reach this stage, you don't need to add another penny. You simply coast. You let the 7 to 10% historical market returns carry you the rest of the way. You have broken orbit. So, why is front-loading so much more effective than the slow and steady approach that every financial advisor preaches? It's the cost of waiting. If you invest $100 and see a 16% return, like we saw in some incredible months of 2025, that growth happens on every single dollar already in the account. Consider this. A person who saves $50,000 by age 30 and never touches it again will likely have more money at retirement than someone who starts saving $1,000 a month starting at age 45. Think about that. You could stress yourself out saving $1,000 a month for 20 years and still end up with less than the person who just went hard for a few years in their 20s. Rhetorically speaking, Would you rather stress for 10 years and be free for 30? Or would you rather stress for 40 years just to be safe for 10? The data from Vanguard and the Federal Reserve proves this. People who miss these early benchmarks spend their 50s and 60s in a state of high anxiety catch-up mode. They are panicked, and often they fail to reach even the median savings of $200,000. That is not a retirement plan. That is a disaster waiting to happen. So how do you get out? You have to calculate your specific coast number. This isn't magic, it is math. Take your target retirement goal. Let's use that $1.26 million figure everyone is talking about. Now, use the rule of 72 or a compound interest formula to work backward. Let's say you're 30 years old and you want to retire at 65. You have 35 years for your money to grow. With a conservative 7% inflation-adjusted return, your money doubles roughly every 10 years. That means 10 years from now, it doubles. 20 years, it quadruples. 30 years, it multiplies by 8. If you do the math, this means you only need about $160,000 today to reach that $1.2 million goal without ever adding another cent. Your mission, your only mission, is to find the gap between your current savings, like the Gen Z average of $13,500, and that coast goal of $160,000. Then you bridge that gap as fast as humanly possible. You front load, you hustle, you sacrifice now so you never have to sacrifice again. And here's the best part. Once you hit that coast number, the rules of life change. You no longer need that high-salary, high-stress corporate job to fund your future, because your future is already funded. The compounding is doing the work for you. You can pivot. You can switch to barista fire, taking a lower-intensity job that covers only your immediate cost of living, like your rent and your groceries. You don't need to save for tomorrow anymore. Use tax-advantaged accounts like Roth 401ks and IRAs early to maximize the tax-free growth we saw in those 2025 market surges. Stop looking at your retirement as a destination you reach when you were old and gray at age 65. Start looking at it as a mathematical threshold you can cross in your 30s. The goal isn't to stop working entirely. Humans need to work. The goal is to stop working because you have to and start working on what you want to. This is not a joke. The math is real. The question is, are you going to start the engine now, or are you going to stay on the ground forever?